You already paid taxes on this money once, back when you earned it. And now the government can tax your Social Security check a second time on the way out. If that makes your blood pressure rise, you're not wrong to feel it. But here's what almost nobody explains calmly. Whether your benefits get taxed and how much comes down to a single number you have more control over than you think. In the next few minutes, I'll show you exactly how that number works, why up to 85% of your check can land in your taxable income, and the honest moves that keep more of it in your pocket. No outrage, no spin, just the math and what you can do about it. Welcome in. I'm Ray. I've spent a lot of years helping people make sense of Social Security, and today we're taking on the subject that fills my mailbag with more heat than any other. The tax on your benefits, not whether that tax should exist. That's a fight for Congress, and I'll leave it there. Today is about how the tax actually works, because once you see the machinery, you'll also see the handful of places where you have a real say in what you owe. My promise is the same as always. Calm math, honest numbers, no scare tactics, and no sales pitch waiting at the end. Pour a cup of coffee and let's walk through this together. Let me start by agreeing with you. Every paycheck you ever earned had FICA taken out of it. You paid into this system for 30, 40, maybe 45 years, and you paid income tax on those same wages while you were at it. Now, you're retired. The check you were promised finally shows up, and the IRS can reach into it a second time. Plenty of people call that double taxation. I'm not going to talk you out of the feeling. It's understandable, and frankly, if a piece of you didn't bristle at it, I'd wonder whether you were paying attention. Here's the turn, though, and it matters. Over the years, I've watched people stay angry about this tax for a decade and never once sit down to see how it actually gets calculated. That anger costs them real money. There are legal, ordinary, boring decisions that change how much of your benefit gets taxed, and you can't make any of them if you've never looked at the formula. Getting mad doesn't lower the bill by a nickel. Understanding one number can. Let's go get that number. The IRS decides how much of your Social Security is taxable using something called combined income. You'll sometimes hear it called provisional income. Same thing, two names. The recipe is short, so stay with me. Start with your adjusted gross income. That covers your pension, your traditional IRA and 401k withdrawals, wages if you're still working, interest, dividends, and capital gains. Next, add any tax-exempt interest you have, like interest from municipal bonds. Yes, the tax-free stuff still gets counted here. Then comes the part people miss. Add 1/2 of your Social Security benefits, not the whole check, half. Add those three pieces together and you have your combined income. That total is the whole ball game. Every dollar question about the tax on your benefits runs through this single number, so it's worth knowing yours, cold. Let me repeat the half part, because it's genuinely good news. If your Social Security comes to $22,000 a year, only $11,000 of it counts toward this number. The formula starts by setting half your benefit aside before anything else happens. Notice one more thing about the recipe. Certain kinds of money go into it, and certain kinds don't, and you often get to choose which kind of money you live on in a given year. Hold that thought. That's where your control lives, and we'll come back to it. First, the thresholds. Here are the lines that matter for 2026, and I'd love for you to write these down. If you file as a single person and your combined income is below $25,000, none of your Social Security is taxed. 0. Between $25,000 and $34,000, up to 50% of your benefit can be included in your taxable income. Above $34,000, up to 85% of your benefit can be included. Married filing jointly works the same way with different lines, $32,000 and $44,000. Now the sentence I need you to hear more than any other in this episode. That 85% is not a tax rate. Nobody takes 85% of your check. What the rule says is that up to 85% of your benefit gets counted as taxable income, and then you pay your ordinary tax rate, whatever bracket you're in, on that counted portion. I've met people who genuinely believe the government would keep 85 cents of every Social Security dollar. It kept them up at night, and it was never true. One more small comfort hiding in the fine print. Those words "up to" are doing real work. Crossing a line doesn't flip a switch that instantly taxes half your benefit. The amount phases in gradually as your income climbs past each threshold, dollar by dollar. Sitting $1 over a line is nothing like sitting $10,000 over it. Let's make it concrete with round numbers. Picture Margaret, a single filer collecting $22,000 a year in Social Security. Half of that, $11,000, goes into her combined income. Suppose she also pulls $12,000 from her traditional IRA. 11 plus 12 is $23,000. That's below $25,000, so not $1 of her benefit is taxed. She keeps everything. Now suppose instead she withdraws $20,000 from that IRA. 11 plus 20 puts her combined income at $31,000, inside the middle band, and a portion of her benefit, up to half, gets pulled into her taxable income. Push the withdrawal to $30,000, and her combined income hits $41,000 over the top line into the up to 85% zone. Even in that worst case, look at what actually happens. At most, about $18,700 of her $22,000 benefit gets counted as income. If Margaret sits in the 12% bracket, the tax on that comes to roughly $2,200. Real money, and worth shrinking. But it's $2,200, not $18,000. Nobody confiscated her check. At this point, you might be thinking, fine, but why does this tax reach so many ordinary retirees? $25,000 is not a rich person's income. You're right, and the reason validates a suspicion a lot of you carry. Those thresholds are frozen in time. The $25,000 and $32,000 lines were set in 1983. The $34,000 and $44,000 lines were added in 1993. Congress never indexed any of them to inflation. Your benefit rises with the cost of living every year. The tax lines it gets measured against have not moved an inch in over 3 decades. The result is a slow-motion squeeze. Back in 1984, fewer than 1 in 10 beneficiaries owed any tax on their Social Security. Today, it's roughly half of all households collecting benefits. Nobody passed a new law to make that happen. Inflation simply carried ordinary retirees across lines that were drawn when gasoline cost about $1 a gallon. If that $25,000 single threshold had been indexed like most of the tax code, it would sit above $75,000 today. The married line would be above $96,000. Under those numbers, most of you watching would owe nothing on your benefits at all. I know how that lands. It feels like the game moved the goalposts by refusing to move them. You're not imagining it, and you're not alone in it. For what it's worth, administrations from both parties have come and gone since 1993, and none of them touched those lines. This isn't one side picking on you. It's 4 decades of quiet neglect that happened to be very convenient for the budget. Since we can't redraw the lines ourselves, though, let's talk about what Washington did pass recently, and then what you can actually do. In 2025, Congress passed what's officially called the One Big Beautiful Bill Act, and you may have heard the phrase, no tax on Social Security attached to it. I want to give you the honest version, because the slogan and the law are not the same thing. What the law created is a new bonus deduction for seniors. If you're 65 or older and file single, you get an extra $6,000 deduction. A married couple where both spouses are 65 or older gets $12,000. It applies for tax years 2025 through 2028, and it starts phasing out at higher incomes, around $75,000 for a single filer and around $150,000 for a married couple. That's genuinely helpful for a lot of people. A bigger deduction means less taxable income, which for many retirees shrinks the overall tax bill, including the tax that lands on their benefits. But here's the correction, offered gently. The law did not make Social Security tax-free. The combined income formula we just walked through is still on the books, untouched. Up to 85% of your benefit can still be pulled into taxable income, same as before. The deduction softens the blow for many, does little or nothing for some, and it's currently set to expire after 2028. If someone told you the tax on benefits is gone, they were repeating a slogan, not reading the law. You deserve the actual text. Now for the part I most want you to take away. Remember what I said about the recipe. Some money counts toward combined income, and some money doesn't. That difference is your steering wheel. Here's what does count. Withdrawals from a traditional IRA or 401k, pension payments. Wages, interest, dividends, and capital gains you realize by selling something. Every one of those dollars pushes your combined income up and can shove you across a threshold. Here's what doesn't count: money you withdraw from a Roth IRA. Those dollars come out federally tax-free, and they never touch your combined income. Also, a qualified charitable distribution, where money goes straight from your IRA to a charity you support. If you're 70 and a half or older and you already give to your church or a cause you love, giving directly from the IRA keeps that money out of your adjusted gross income entirely, and it can even count toward a required distribution. Timing matters too. A big withdrawal squeezed into one calendar year can vault you over a line that two smaller withdrawals, in December and January, would slide right under. The same goes for selling something with a gain in it, a chunk of stock, a piece of land. The year you choose to sell is the year that gain lands in your combined income, and sometimes you have more flexibility about that year than you think. Let me show you what this looks like in a kitchen instead of a textbook. A while back, I sat with a fellow I'll call Walter, 69, a retired electrician. His Social Security paid him $24,000 a year, so $12,000 counted toward his combined income. He wanted to pull $25,000 from his traditional IRA to replace his truck. Do it all in 1 year, and his combined income hits $37,000, past the $34,000 line, deep into the up to 85% zone. Instead, he took part of it in late December and the rest after New Year's, and he covered his usual church giving straight from the IRA as a charitable distribution. Each year stayed in the middle band instead of the top one. Walter still bought the truck. He still gave what he always gave. A meaningfully smaller slice of his benefit got taxed simply because he watched the calendar and the source of each dollar. No loopholes, no schemes, just the formula used with his eyes open. I'll add one caution because I promised honesty. Don't twist your whole life into a pretzel to duck a threshold. And don't let anyone stampede you into converting everything to a Roth because of one YouTube video, including mine. Sometimes paying the tax is the right call. The point is smaller and sturdier. Know where the lines are before you move money, because the same dollars, moved a little differently, can leave more of your check with you. Before we close, here's a short homework assignment. 5 minutes, a pencil, and last year's tax return. First, figure your combined income. Adjusted gross income, plus any tax-exempt interest, plus half your Social Security. One line of arithmetic. Your Social Security total is on the SSA 1099 form that arrives every January, and your adjusted gross income is right on the front of your return. Second, find your threshold, $25,000 and $34,000 if you're single, $32,000 and $44,000 if you're married filing jointly. Mark which side of the lines you're on and how close you're standing. Third, if you're within a few $1,000s of a line, ask one question before your next big withdrawal or sale. Could shifting the timing or drawing from a different pocket like a Roth or a charitable distribution keep me under it? Sometimes yes, sometimes no. Asking costs nothing. Fourth, check whether the senior deduction applies to you. 65 or older. Income under the phase-out range, tax years 2025 through 2028. If it fits, make sure whoever prepares your return knows your age and claims it. That's the whole checklist. Anyone who can balance a checkbook can do it, and doing it once a year, ideally in the fall while there's still time to adjust, is worth more than 100 angry comment threads. Let's land this plane. You can't repeal the tax on Social Security from your kitchen table. The frozen thresholds, the 85% rule, the fine print of the new deduction, all of that sits in Washington's hands, and I won't pretend otherwise. But your combined income? That number is substantially yours. Which account you draw from, when you draw it, how you give to charity, when you sell the thing with the gain in it. Those choices belong to you, and they're the difference between a benefit that's mostly untouched and one that's taxed more than it had to be. The retirees who keep the most aren't the loudest ones. They're the ones who know their number, know their line, and make the quiet moves. As I like to say, the formula doesn't care how you feel about it, but it does respond to what you do. Now the serious words, and I mean them. This episode is education, not tax advice. and not financial advice. Your situation has details I can't see from here, so before you act on anything you heard today, sit down with a qualified tax professional and run your own numbers. Rules change, and your state may treat things differently too. If this cleared the fog a little, share it with a friend who's still furious at a tax they've never actually seen on paper. I'm Ray. Thanks for spending this time with me, and I'll see you in the next one. Take care of yourself.